Welcome to The Explainer. Today, we're jumping straight into the deep end. We're going to decode the language of the financial markets. Let's break down those charts, that jargon, all the tools traders use to try and make sense of the noise. Okay, so have you ever looked at a trading screen like this one and just felt completely overwhelmed? Yeah, you're not alone. It's just a wall of information, right? Well, stick with me, because by the end of this, you're going to understand what all these flashing numbers and crazy charts are actually trying to tell you. So to really understand any market, doesn't matter if it's stocks, crypto, whatever, you got to start with its DNA. And that core building block, that live record of every single person wanting to buy or sell, that's what we call the order book. Yup, the order book. You can think of it like the market's totally transparent diary. Seriously, it's this constantly updating list that just lays it all out there. The raw, unfiltered supply and demand for an asset at every single price. You know, every single order book is basically a constant negotiation. It's like this digital tug of war happening in real time. On one side, you've got the buyers, right? They're placing bids. That's the price they're willing to pay. And on the other side, you have the sellers placing asks. That's the price they're willing to sell for. And a trade? Well, that only happens when a bid and an ask finally meet in the middle. Okay, so what about that gap? You know, this space between the absolute highest price a buyer will pay and the lowest price a seller will take? That's called the bid-ask spread. And it is not just some random gap. It's actually the immediate cost of making a trade, and believe me, it tells you a ton about how healthy a market is. Just look at this. It's a perfect example. See how the spread tells a story? In a market with high liquidity, lots of buyers and sellers, that gap can be tiny, maybe just $1. That means trades are cheap, they're efficient, but in a low liquidity market, whoa, that spread can blow out to $100. That not only makes trading way more expensive, but it also brings in this nasty risk called slippage. That's where the price you think you're getting isn't the price you actually pay. Ouch. All right, so staring at lists of numbers, I mean, it works, but let's be honest, our brains love pictures. So the big question is, how do we take all this raw data from the order book, all that supply and demand, and turn it into something we can understand in a split second? Well, here's your answer. This is a market depth chart. This is what turns that boring list of numbers into a vivid picture. See that green mountain? That's the cumulative wall of buy orders, all the demand. And the red mountain? That's the wall of sell orders, all the supply. Bam! In one single glance, you can literally see where the pressure is building up. And check this out. When you see a massive spike on the buy side, I mean like a giant green cliff, traders have a name for that. They call it a buy wall. It's a huge signal that there is a ton of buying interest right at that price. And that wall, it can act just like a floor, a support level that makes it really, really hard for the price to fall any further. Okay, so understanding the market's structure with these buy and sell walls, that's super powerful. But it's kind of a static picture, isn't it? It's a snapshot. What traders also need to know is, where's the momentum? You know, is the price picking up speed? Is it about to slam on the brakes and change direction? To figure that out, traders have this whole toolkit of indicators, but two of the big ones, the ones you'll hear about all the time, are the RSI and the MACD. Now, they both measure momentum, but they do it in slightly different ways, giving us unique little windows into the market psychology. Let's start with the RSI. I love this analogy. It's basically a speedometer for the price. It's this line that bounces between 0 and 100. When that needle climbs above 70, it's a hint that the market might be getting a little overheated, what traders call overbought. And if it drops below 30, well, that suggests the asset is oversold, and maybe the sellers are just running out of steam. Then you've got the MACD. This one's a bit different. It works by comparing two moving averages of the price, a fast one and a slow one. So the MACD line itself, that's kind of showing you the short-term trend. The signal line is a smoother, slower version of that. The real magic happens when they cross. A fast line crossing a slow one can signal a shift in momentum. And that histogram, those little bars, that's just a visual of the gap between the two lines. The bigger the bars, the stronger the momentum. Okay, now here's a really cool and pretty powerful concept that applies to both of these tools. It's called divergence. Just imagine this. The price of an asset is chugging along, making new high after new high, but You look down at your RSI or your MACD, and it's actually making lower highs. See that disagreement? That's a classic warning sign. It's like the price is still going up, but the energy, the momentum behind it is fading. It's a huge hint that the trend might be getting ready to turn around. So, how do you actually use these things together? Well, here's a pretty simple strategy. Let's say you're looking for an entry point. Step 1. You wait for the RSI to pop up from below 30, signaling that maybe the selling is over. But you don't jump in just yet. You wait for confirmation. Step 2. You look for the MACD line to cross above its signal line, a golden cross, to confirm that, yes, upward momentum is building. Then you might consider your move. The key thing here, and this is really important, is not to go crazy and clutter your screen with like a dozen different indicators. As the folks at AllTradey point out, using just 2 or 3 tools that work well together is usually the sweet spot. It's enough to get that confirmation you're looking for without giving yourself analysis paralysis, All right, so you've got your indicators, you've got a strategy. That's all you need to succeed, right? I mean, it's so tempting to think that once you find that perfect setup, you're golden. But the real world of trading is always more complicated. Yeah, ask any experienced trader, like this user on Reddit, and they'll be the first to warn you about a dangerous trap called overfitting. What's that? It's when your strategy looks absolutely incredible on past data, but only because you've tweaked it so perfectly to fit that exact history. The problem is, when you unleash it on a live, unpredictable market, it often falls apart. And it's not just overfitting. Your brilliant strategy also has to survive contact with reality. And reality has hidden costs. You've got slippage, remember that, where your entry price isn't what you thought. You've got transaction fees, which nibble away at your profits with every single trade. And then there's the biggest wild card of them all, your own psychology. As one trader put it so well, unless you're a sociopath, you're probably not going to follow your strategy perfectly. You'll sell too early, you'll buy too late. We're only human. And look, this isn't just traders telling stories. It's backed by research. A recent academic paper found that, yeah, those order book imbalances we talked about, they do have some predictive power for where the price is going next, but that edge lasts for a matter of seconds. It just disappears, which really hammers home the point. This is a game of probabilities, not prophecies. So what's the big takeaway from all this? It's that these tools, the order book, the depth chart, RSI, MACD, they are not a crystal ball. None of them are. They don't predict the future. They help you see the probabilities a little more clearly. So the real question isn't, can I find a tool that tells me what's going to happen? The real question is, can I manage my risk when I know I can't be certain?